Folks, it is Dr. Jeff Camarda. Good afternoon as I record this, a little bit late in the day after 4 o'clock on Monday, September 13th. Again, I'm not sure when Rick will cue this up to disseminate it to you, so it may be a few days from now, but it'll still be fresh and timely. And a number of you, have asked about, our new portfolio methodology that we've really been grinding away at for a year and a half now, which I feel that Kim and now with the addition of Jonathan Camarda, we've really perfected and very happy with the results. But the entire effort is designed to protect your portfolios and preserve wealth for your families and for your retirement during a time of, very, very unstable economic and market conditions. As I have opined repeatedly over the past year and a half, this is not normal. The world is on fire. It continues to burn, yet stock valuations and many other assets have levitated up into space. So I wanted to make a point today to read this to you from today's Wall Street Journal. I'm going to read the entire thing, which is unusual for me, but he makes some really, really good points. So take it for what it's worth. But I've got to begin by setting the mood by playing some mood music. And this is Carl Orff's wonderful Carmina Burana first movement, and certainly strikes the appropriate ominous tone. So the stock market, Andy Kessler in today's Wall Street Journal, the stock market fails a breathalyzer, he says. Joby Aviation, which plans to begin an electric air taxi service in 2024, parenthesis, unproven speculative concept, close parenthesis, is worth more than Lufthansa, EasyJet, or JetBlue. Does that seem right? In this market, why not? Heck, earlier this year, Tesla was worth more than the next 9 car manufacturers combined, though now only the next 6. Beyond Meat, made with pea protein, is worth more than the entire market for peas eaten globally. Like the bumper sticker says, imagine world peas. Do fundamentals even matter anymore? I can go on. Used car platform Caravana is worth more than Volvo, Honda, Ford, or Hyundai. Airbnb is worth more than Marriott and Hilton combined. Crypto exchange Coinbase is worth more than the NASDAQ. I live at the intersection of innovation and disruption, but when companies are worth more than any possible reality, watch out. How about those meme stocks still getting hyped on Reddit's Wall Street bets? Those who bid GameStop shares into the stratosphere waved at Virgin Galactic Holdings as they soared by. A year ago, the stock was $6 and now it's $190. But some dupes paid $483. Game over for them. Short sellers have gotten hammered and their assets handed to them. Shorts lost more than $9 billion between January and June. Betting against this, wisely betting against this just crazy trend. New chairman Ryan Cohen, who is driving change at GameStop, may be a retail genius for turning around Chewy, but Redditors may want to put in a call to hedge fund manager Eddie Lampert, remember him, who bought Kmart and merged it with Sears in 2005 as a highly touted integrated retail play, combining stores and online sales, eerily similar to the argument for investing in GameStop today. The stock, and now with Sears, peaked at $135 in 2007. It is now at 30 cents as the company languishes in bankruptcy. A 1970s Sears Johnny Miller leisure suit is worth more. AMC Entertainment stock was scraping $2 at the end of 2020. It is now $50 thanks in part to Robinhood speculators, and the company has smartly raised cash. But what about fundamentals? Making money, what a company is designed to do, right? Theaters are still sparse, and Disney and others are willingly putting blockbusters directly into the streaming services. Ask Scarlett Johansson about Black Widow's ticket sales. I watch at home now. It's great. I prefer it. I'm not sure I'll ever go back to a theater. As getting back to the article, theaters are the new roller rinks now. Venture capital is cuckoo. After investing $120 billion in the 2000 dot-com frenzy and just $16 billion in 2002, U.S. venture capital invested $130 billion in 2020 and then $140 billion in the first half of 2021. Startups these days raise money as the Uber of gardening or space as a service. Oh wait, the latter was WeWork's pitch, whose founder Adam Neumann declared in 2017, our valuation and size today are much more based on our energy and spirituality than on a multiple of revenue. Is spirituality the S in SPAC for special purchase acquisition companies? And check this out, in June, an Italian artist, oh I love this one, auctioned an invisible statue for $18,000. In reality, it was an empty box the artist claimed was space full of energy. WeWork energy? Yeah, maybe fundamentals are a quaint relic of a bygone era. The Federal Reserve deserves most of the blame. Near zero interest rates mean the market has no true north to help compare stock valuations with reality. We are navigating turbulent seas with a spinning compass. Former Fed Chairman William McChesney Martin once explained that the Fed's job was to take away the punch bowl just as the party gets going. From the looks of it, the entire market would blow about a 0.35 as in Dow 35,000 on a breathalyzer test. Punch bowl still intact. No, fundamentals don't matter, well, at least until they do. In 1989, Tokyo real estate sold for as much as $139,000 a square foot. I'm waxing Howard Cosell here, or channeling, I should say. 350 times the value of Manhattan. At that price, Tokyo's Imperial Palace was worth more than all the real estate in California. Not anymore, after Japan's trifunk of lost decades. Yahoo, and I remember this back in the day, that in 2000, Yahoo's trading at a price-to-earnings ratio of 700. It was once worth $125 billion, and AOL $200 billion during the dot-com bubble. Both are worth 99% less today. Tesla CEO Elon Musk recently tweeted, 1999 was peak insanity, but 2021 is 1,000% more insane. Remember, I'm going to repeat this twice, folks. Remember, when the selling starts, fear of missing out turns into a fear of losing everything, and as speculators jump like rats off a sinking ship. Remember, when the selling starts, and eventually it will, it always does, fear of missing out turns into fear of losing everything as speculators jump like rats off a sinking ship. Today's negative real yields that means interest rates are lower than inflation and taxes. You lose money having money in the bank. Today's negative real yields don't reflect reality. The Fed has warned it plans on tapering bond and mortgage purchases later this year. Someone is at least reaching for the punch bowl. The compass may stop spinning soon. Until then and always, stick with fundamentals. Now, I don't mean to scare you by all that, but it does accurately reflect, this trepidation I've had about this market untethered from economic reality for a long, long time. There are two truths in investing methodology and the technicals and that I've come to believe wholeheartedly. Number one, the trend is a trend until it's not. And this levitation may continue for a long period of time. And we plan to have you invested and participating in these trends as long as they persist to the best of our ability. And the other platitude is the market can stay irrational, and as it is now, longer than you can stay solvent. The point is markets, particularly in times like this, do not behave rationally. There is really no rhyme or reason to the valuations. And our objective, our new mandate, our investment philosophy is to take advantage of the trends, to preserve and protect your wealth, and to grow it as prudently as we can. But sooner or later, we will see a cataclysm, and our objective is to get you very, very soundly out of the way into a safe environment until it passes. And for the nonce, I'm sorry, Carl was not as loud as I'd like. Maybe we can crank it up a little bit here. Is it still there? I barely hear it. Oh, well. For the nonce, that is Jeff Camarda. Thank you so much. Those of you that are still listening, until next time, Please have a wonderful week in wealth. Bye-bye.